Today we focus on the topic of private debt, a market that has quietly grown into a multi-trillion-dollar industry, reshaping how companies borrow money and how investors earn returns. By the end of this video, you'll understand what private debt is, why it matters, and how it affects both businesses and the global economy. Let's start simple. Debt means borrowing money. Traditionally, companies go to banks for loans or issue bonds in public markets. But private debt is different. Here, companies borrow directly from private lenders, specialized funds, pension funds, insurance companies, or wealthy investors. These loans don't trade on public exchanges. They're negotiated privately, hence the name private debt. Private debt really took off after the 2008 financial crisis. Banks faced stricter regulations and became more cautious about lending, especially to mid-sized companies. That left a gap. Private funds stepped in to fill it, offering loans where banks hesitated. Over time, this grew into a massive market. In 2010, private debt funds managed a few $100 billion. By 2023, that figure had surpassed $2 trillion, and it's still growing. Yet, private debt isn't just one thing. It comes in several forms. Direct lending, straightforward loans to companies, often mid-market firms. Mezzanine financing, a hybrid of debt and equity used in buyouts or expansions. Distressed debt, investing in troubled companies, betting on a turnaround. Special situations, unique one-off financing deals. Each type carries different risk levels and return potential, but they all serve the same purpose, giving companies access to capital outside traditional banking. Okay, now we know what private debt is all about. Next, let's know why it is interesting for companies. For companies, private debt offers a wide range of advantages. Flexibility in terms. Unlike banks, private lenders negotiate directly with the borrower. That means repayment schedules, interest rates, and collateral can be tailored to the company's specific situation. Speed of execution. Private debt funds often move faster than traditional banks. For businesses facing time-sensitive opportunities, like acquisitions or expansion projects, this speed can be critical. Access for mid-market firms. Many mid-sized companies are too large for small bank loans, but too small to issue bonds in public markets. Private debt fills this gap, giving them access to capital that would otherwise be out of reach. Less regulatory friction. Banks are bound by strict capital requirements and regulations. Private lenders operate with more flexibility, which allows them to finance projects that banks might reject. Confidentiality. Because deals are private, companies can raise funds discreetly without triggering speculation or market reactions. All right, and without investors, there would be no market for private debt. So why are investors interested in private debt? For investors, private debt is equally compelling. Higher yields. Compared to government bonds or investment-grade corporate bonds, private debt typically offers a premium of 2 to 4 percentage points. Diversification. Private debt tends to be less correlated with public equity markets. This means portfolios can become more resilient to stock market volatility. Inflation protection. Many private debt agreements include floating interest rates tied to benchmarks. This helps investors maintain returns even when inflation rises. Exclusive opportunities. Investors gain access to deals that aren't available in public markets, creating unique chances for returns. Active involvement. Unlike buying a bond on the open market, investors in private debt can negotiate terms and influence risk management directly. But let's be clear, private debt isn't risk-free. Let's have a look at the typical risk and challenges associated with private debt. Liquidity risk. These loans aren't traded publicly, so selling your investment quickly is difficult. Default risk. If the borrower fails, investors can lose money. Transparency risk. Because deals are private, information may be limited compared to public markets. Concentration risk. Funds may lend heavily to certain industries, making them vulnerable to downturns. Okay, now we know about the advantaged and risks associated with private debt. Private debt has become a cornerstone of modern finance. It helps companies grow, supports innovation, and gives investors new opportunities. But it also raises questions. Are we creating hidden risks outside the regulated banking system? Could private debt funds face trouble in a recession? These are debates economists and regulators are watching closely. So, to sum up, private debt is the private lending market where investors step in to finance companies directly. It's flexible, fast-growing, and potentially rewarding, but it comes with risks. If you enjoyed this breakdown, hit like, subscribe, and share it with someone curious about modern finance. Thank you for watching and have a good one.